Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us as we take a look at bearish spreads, bearish spread trading strategies. But with us today, I do want to welcome Russell Rhoads. Russell is actually a CFA and an instructor with the Options Institute that's located or coordinated with the Chicago Board of Options Exchange. He actually joined the Institute 4 years ago after a career as an investment analyst and a trader with a variety of firms. Russell's also a financial author and editor, having contributed to magazine articles as well as edited several books and is now published. He's written a book on option spread trading and also has another one recently released on trading VIX derivatives. Now, with all of that going for him in his spare time, he also instructs a graduate level options course at the University of Illinois in Chicago. So with that, I'd like to welcome Russell. Thank you for joining us, Russell. Let me actually move this. I see you've unmuted your phone right now. I'm going to put this on your slide, pass you the ball, and we'll get underway. Thanks for joining us, Russell.
Okay, thanks a lot for having me today, Cynthia. As I often say when I get started with Interactive Brokers, not only, I guess it's almost like Hair Club for Men or something like that. Not only am I doing a webinar on behalf of the CBOE and doing it in conjunction with Interactive Brokers, I've been an IB client since, gosh, well over 10 years now. So I always enjoy getting to do things with Interactive Brokers because, like I assume a lot of people that are online right now are, I'm a big fan of IB and big fan of the clients as well. I always get some good and challenging questions when I'm going through a webinar for Interactive Brokers, and feel free to lob questions in as I go along today. If you were with us last month, or if you've seen the recording, I did a webcast on bullish spreads. This is April, so we're the 4th month of the year. We are 4 of 12 into webcasts that are going to start out at the very basic level. Back in January, we did a very basic webcast, and by the end of the year, we are going to get up to calendar spreads, ratio spreads, portfolio margin, some very difficult stuff. So as we go through the year, we're going to keep ratcheting it up a notch. Bullish spreads and bearish spreads are kind of equal. I think visualizing bullish is a little bit easier for people than bearish sometimes. So we're going to take it up a little bit from March, and next month, if there's 3 directions the market can move: bullish, bearish, or neutral. Next month, we're actually gonna hit on neutral spreads. So there's my disclosure statement. I'm with the CBOE, so you don't have to read this. I'll tell you the most important part. Most important part is that I'm here for educational purposes only. I'm going to use teaching stocks, which are not real tickers, for my examples today. Also, my examples don't include commissions. A big reason for that is just to keep the math somewhat simple. We're all about the concepts and a little bit about the math today, but definitely want you to come away more with concepts than math. Going to run through just what spread trades are and then start to hit on bearish spreads. And we're going to take a look at, I mentioned neutral in passing just a couple of slides ago. We're going to talk about very bearish, then we're going to talk about just having a neutral outlook with a bearish bias to it. And then we'll finish up with getting into an intermediate strategy here. We'll finish up with a bearish diagonal a bearish diagonal spread. I'll run through a summary, and then if you ask a question as I go along and I didn't hit on it, I'll do my best to circle back to it. My contact information is at the end of the webcast. If a question hits you later, or if you are watching this as a recording, feel free to shoot me an email here at the CBOE. Sometimes it might take a day or two for me to get back to you, depending on my travel schedule, but I do my best to answer all questions that come in via email. But I do encourage questions. Option spread trades. We're just going to do an introduction to spreads, and then, like I said, we're going to get into the bearish end of things. Option spread trades, basically you're combining a couple of positions. It can be options on the same underlying. It can be options with the underlying. That range of possibilities is endless. I throw that out there, and whenever I'm doing a presentation and I say that, I'm always tempted to to pull every option contract that's being quoted on a stock like Google or Apple right now and figure out exactly how many potential just two-leg spreads could I come up with, combining all of those option contracts. That I've got a summer intern coming in a few weeks. That might be a good job for my summer intern. But the truth is that the possibility when you are taking a look at option spreads, it truly is an endless number of potential spreads that you can come up with. Option spreads can be as basic as the covered call. Covered call is when you own a stock, in this case long VRM, 100 shares of VRM, and we're short one of the April 55 calls. We're a willing seller there of that stock up at 55, and we've taken in some premium, taken in $2 to take on that obligation. This is actually an option spread trade. Taking it up 5 notches real quick, maybe it's a skip strike or a broken wing butterfly. Long 1 call, short 2 calls, skipping a strike, and then long another, a 60 strike call. Both of these trades, although one is very basic and one gets up to the complex end of things, both of these trades qualify, come under the umbrella of an option spread trade. Now today we're going to concentrate on the downside, not a market opinion or anything like that, even though the market's down a little bit today, but we're just going to concentrate on the bearish end of things. And we're going to start out with probably the most basic spread trade, a vertical spread with a bearish tint to it, or a vertical bear spread. We're going to combine 2 options. We're going to buy and sell one. We're going to buy one and sell the other. Both the option contracts that we're going to take a look at in our examples are going to be the same type. In fact, they're both going to be put options. They're going to have the same expiration. The big difference here is we're going to sell one strike and buy another strike. And the outcome, again, is going to be based on a negative or a bearish outlook for the underlying. Here's a couple of examples of bear spreads. Short one of the June 35 puts and long one of the June 40 puts, or short a June 35 call and long a June 40 call. Now for both of these, and actually we'll take a look at what the cost or the income would be. In the case of the put spread, the bearish put spread here, we would pay out $2.95. In the case of the call spread, we would actually be selling an option contract that has more value than the option contract we're paying for. We're taking in $3.55 and we're paying out $1.50. So in this case, we would actually take in some income when we would put this spread on. Those of you that are familiar with vertical spreads or familiar with spread trades would realize the risk reward on this trade is actually the same. Both of them have a potential risk of $2.95 and a potential reward of $2.05. I will expand on that as we take a look at our trading example here. So let's take a look at a trade. We've got my stock VRM trading here at 47.5. We think the stock, we're very bearish here. We think that stock's trading down to 40 over the next couple of months. As we are in mid-April, as I speak, the months here are accurate. Again, this is it's not a real ticker, but the months are accurate. 8 weeks out, we've got June expiration. In fact, that right there should say 8 weeks. And what we're actually going to do, we're going to put on a spread, but we're going to put on a spread using put options. Now, we could use call options, but just to keep the illustration kind of easy, we're going to stick with using puts in this case. And what we're going to do is we're going to buy one of the 45 strike puts. We're going to pay $1.95 for it. And at the same time, remember our target price is 40. We're actually going to sell one of the June 40 puts and take in 50 cents. That 50 cents is going to help offset the cost a little bit on that June 45 put, paying out $1.95, taking in 50 cents. So the net result is going to be a cost of $1.45. So now in the next slide, we're going to take a look at a table that gives us an idea of how the profit and loss for this trade works out. and how we determine the profit and loss for this trade. Now, first off, what I like to do when I'm taking a look at one of these, when I'm putting together a payoff table, I actually like to fill in either the cost or the income, depending on what type of trade we did. In this case, we have a cost or a debit. I like to fill that in and then add up the impact of each of the options involved in the spread to get a final profit and loss. I think it's a good way to isolate each of the moving parts here. We've got the cost, what was involved in initiating the trade. In this case, we paid out $1.45 when we initiated the trade. Now we're going to take a look at our short put. We have taken on the obligation to buy 100 shares of VRM at 40, and at any price from 40 and lower, there's going to be some value in that June 40 put. It's going to be in the money if at expiration if our stock is below 40. So let's focus in on that 35 where I've got the laser pointer right now. Focus in on that 35 price. If the stock's down at 35 at expiration, that June 40 put is going to be $5 in the money. However, we're short that June 40 put. So it's going to be $5 working against us. Now, that's not the only option position that we've got in this spread. We can see that because we've got the long VRM June 45 put, and at any price below where my laser pointer is right now, at any price below 45, we're going to have some value in that June 45 put. Why don't we just continue to focus in on the 35 line today. With the stock at 35 at expiration, we own the right to sell the stock up at 45. There's $10 of value there. Now we can sum up all of these, sum up each of these. We got a minus $5 plus $10 minus $1.45. The net result with the stock at 35, the net result with the stock at 40, which was our target price when we started out here, net result with our stock at 40 is a profit of $3.55. Anywhere from 45 and higher, we've got a loss of $1.45. This is and this was our target price right here where I've got the laser pointer. We've got a maximum risk on this trade of $1.45 and a maximum reward of $3.55. Now we're going to take a look at these key price levels and the payoff diagram for this trade. This is a payoff diagram for a bear spread, whether it's put together with put options or call options. And what I actually like to do when I'm taking a look at payoff diagrams, I like to show where the stock is when we initiated that trade. There's a difference between having the stock right here and maybe having the stock over where I put the laser pointer, maybe down at 35 when we initiate this spread. We're going to take a look at what that difference is in the next example. With the stock at 47.5, we're looking to hit this price right here. We're looking to hit 40 at June expiration. We think our stock's going to trade down and trade down pretty aggressively over the next couple of months. That's where we expect the stock, down there at 40, where we would have a profit of $3.55. We need the stock to get below 43.55 in order to break even on the trade. Remember, we're starting about where the laser pointer is. We're starting there at 47.5. And then finally, at any price from 45 and higher, and that includes the price where the stock is when we initiated this trade, at any price at 47.5 or at 45 and higher, including 47.5, we would incur that maximum loss of $1.45. So we've got to get some movement. We've got to get some bearish movement. That's why I entitled this slide "Very Bearish." Now, mechanically, here's what might happen at expiration. If if the stock is over 45 at expiration, both options are going to expire without any value. We're not going to have any value in those option contracts, and we're going to be out that $1.45 that we paid for the spread. Now, between 40 and 45, that 45 strike put is going to be in the money. And depending on how much in the money it is, we'll either have a partial loss or a partial gain relative to our maximum potential loss or maximum potential gain. And then finally, with VRM under 40 at expiration, both put options are in the money, but as we saw a couple of slides ago, as we saw on that payoff table, the long option, our long 45 strike put, is going to be worth $5 more than our short option, that short 40 put. And there's $5 of value in that spread. We paid $1.40, or we paid $1.45 for a spread that's worth $5. The net result there is going to be a profit of $3.55. So we took a look at using a bear spread when we've got a very bearish outlook. How about when we've got a neutral to bearish outlook, or bearish to neutral outlook? Stock's going to be at the same price, but in this case, we think maybe the stock's going to trade lower, but we're pretty certain the stock's not going to trade higher. We're just not sure if our bearish move, we've got a long-term bearish outlook on VRM. I think the stock's going to trade down over time. We're just not sure how long it's going to take for that move to get going. We're comfortable putting this position on for the next couple of months and taking a look, again, today being mid-April, we're going to take a look at June expiration, 8 weeks out in the future. We're going to sell one of the VRM 50 puts, and we're going to buy one of the VRM June 55 puts. Now, the net result here is going to be paying out a little bit more than we paid out for that other spread, and we're going to see why in just a minute. The net cost in this case is $3.75. So before we paid $1.45 for a bear spread. For another bear spread, we're going to pay $3.75. We're going to pay more, but there's a risk-reward reason behind this. So starting out with the payoff table once again, we've got our cost. We're going to fill in our cost at $3.75. Now we're going to take a look at that 50 strike put, and at any price below 50, that option contract is going to be in the money at expiration. It's going to have some value. That value is going to be working against us. We're short that VRM June 50 put. Now we also own one of the June 55 puts. At any price below 55, there's value in that option contract. That option contract is in the money at expiration. And being in the money and being long an option contract that's in the money, that's a good thing for us. And let's take a look at 50, for instance. At 50, there's $5 of value in that option. There's no value in that 50 strike put that we're short. Well, we got $5 of value in that June 55 put. And then we sum up the columns, and the net result here is at 50, we've got a profit of $1.25. Up at 55, 55 is where our maximum potential loss is, we've got a loss of $3.75. Well, our previous example, we had a potential loss of $1.45 and a potential gain of $3.55. Well, why was that? Well, let's start out with the payoff diagram and look at where the stock is. Remember, in our previous example, the stock was over to the right, was in an area where you'd have your maximum potential loss. In this case, the stock is to the left. It's to the left of the lower strike option contract, and it's actually in an area, if the stock doesn't move at all, we actually end up making our maximum profit on this trade, which is kind of nice. You don't have to have the stock move at all, and you could be bearish, and and the move doesn't get going quite yet. You could still make that profit of $1.25 off of this trade. Got our maximum profit of $1.25, and the stock is well in that range. As long as the stock is under $51.25 at expiration, we will have some sort of profit. Again, below 50, we'll have that max profit of $1.25. Now, if the stock goes completely against us, if we were dead wrong and it's at 55 or higher, the net result here is going to be a loss of $3.75. The risk reward, the dollar risk reward, favors, you get paid a little bit more for that very bearish spread than you do for this bearish to neutral spread, but the reason is a little bit more needs to happen, a little bit more needs to go right for you to get the maximum reward on that very bearish spread as opposed to this bearish to neutral spread. Now mechanically at expiration, once again, the June 50 put if both options are over 55, again, both options will expire with no value. We paid $3.75, and we've got no value at expiration. Between 50 and 55, the 55 put is going to be in the money, and we'll have some value from that 55 put. And then finally, under 50 at expiration, both puts are in the money. And if both puts are in the money, we're long a put option that has $5 more in value than an option that we are short. So we pay $3.75 for a spread that is worth $5. Now, I've talked about the risk-reward difference between that very bearish spread and that bearish to neutral spread. Let's take a look at them. Let's overlay those guys on a payoff diagram. Again, right there in the middle is where that stock is when we consider putting this trade on. Stock's at 47.5. You can see, we'll take a look, we'll label which ones these two guys are. That very bearish spread, I'm going to leave the laser pointer where the stock is. That very bearish spread, again, we've got to get some movement out of that stock in order to make our maximum profitability. In the bearish to neutral spread, we're already in that range. So even though the vertical spread it's called a bear spread, you can actually utilize one of these if you have if you have an opinion that we're going to do that we're going to do two of the three potential things, that we're either going to be neutral to bearish. Last month we talked about neutral to bullish. In both cases, you can consider what is thought of as a directional spread, even if you have a neutral opinion on a stock. So the other, we're going to take it to a little bit of an intermediate level here. In addition to a vertical spread, if you have a directional opinion, another idea is always a diagonal spread. And I like diagonal spreads an awful lot. You actually have the ability to kind of have time working for you, to have time decay working for you, because you're going to end up long an option contract that's not quite feeling the passage of time as the short option contract you're trading. One of the things that I think individuals should focus on when you're thinking about trading options is in one way or another having time work for you, having time decay work for you. Diagonal spreads are one of the best ways to have time working for you. Now, a diagonal spread, it takes a couple of options of the same type that are trading on the same underlying. The diagonal spread takes a little bit of a step further. We have different strikes. We also have different expiration dates. We're going to take a look at an in-the-money option contract that expires basically farther out than an at-the-money option contract. That's the way to take a look at these things. A diagonal spread, we'll just give you a straight-up example here. Diagonal spread, we would be short one of the June 40 puts here and maybe long one of the June 45 puts with the underlying trading down at 38. You can initiate this, and they're a little bit more costly than the vertical spreads, but again, you got time decay working for you, which is kind of nice. And we're going to run through an example where we see how time decay can work for you. The passage of having time on your side to plagiarize an old Stone song there. So let's say we've got my stock Zoe trading down at 40, and we think the stock's going to trade to 37.5 over the next 8 weeks or so. We think we're bearish over that same period of time. And in this case, we've got May expiration as opposed to June expiration out 8 weeks. What we decide to do is we decide, thinking that the stock's going to be at 37.5, we decide to sell one of those 37.5 puts, take in $1, and we're going to buy an in-the-money put that's got a little bit more time left until expiration. We're going to buy one of the September 45 puts that trades on ZOE, more time to expiration, and the net result here is going to be a cost or a debit of $5.90. Constance is asking a good question. Is a diagonal another word for a calendar spread? A diagonal is a version of a calendar spread. You're absolutely correct. The difference between the diagonal and what is commonly referred to the calendar spread, this would be a calendar spread if we had purchased the September 37.5 put. Generally, when you're talking about a calendar spread, you have the same strike for both of the option contracts. but you have different dates on the two different option contracts. In this case, a diagonal spread comes from different expiration months and different strike prices. But it's almost like they are extremely similar. If anything, Constance, the motivation behind the two is very similar, and that is getting time decay to work for you. So great question. I appreciate that. So here we go. We're taking a look at our diagonal spread. Remember, the cost on our diagonal spread in this case was $5.90. We're going to fill that in first. We are shooting for the we're shooting at May expiration here, and we're short one of the ZOE May 37.5 puts. At any price below 37.5, that option is in the money at expiration, and that value is going to be working against us. We do have a long option that's going to help us out here. The value is going to be working against us. At any price from 37.5 and higher, we actually will have no value in that option contract. And that's really a big motivation here. We're shooting for that ZOE 37.5 put to expire with no value, and for our stock to be pretty close to that 37.5 strike price. Now I have a little star here. There's time left in the value of this ZOE 45 strike put. So there is going to be a little bit of time value involved in this contract. If the stock is at 37.5, that option contract is going to be worth $8.25. There's still some time value in there. So at 37.5, hitting our target here, we got $8.25 for the 45 put, maybe $10.30 for the 35 put, and so on. But there's not, these are exact numbers here. Still a little bit of time value. Still making an assumption that the option contract has about the same volatility as before. And then we can sum things up, and we can see that if we overshoot our price target, we're going to see a little bit. We're going to take a little bit of a hit, but right at our price target of 37.5, we've got a profit of $2.30. If the stock starts to move higher, that's our risk here. This is a bearish spread, so our hope is that we get a bearish move. And actually, we'd be okay, slightly okay, if we get a neutral move in this case. Remember, the stock started out at 40, and if the stock is at 40 at expiration, we've got about a 50-cent profit here. So that's and you can see there's some curvature to this payoff, and again, that curve emanates or comes from there being time value left in the option contract that's going to be open at May expiration. Comes from that September 45 put. The stock is at a price right there that we would see a small profit. We're shooting for the stock to be right there, right at the tip of our curve. It's our max profit of $2.30. Our break even, and that's a strongly estimated using a pricing calculator. I estimate that our break even is around 40.75. And our maximum potential loss, and the maximum potential loss theoretically would not be realized until September expiration if the stock is at a price above 45 at expiration. However, at May expiration, we would need the stock to be much higher, where there's no value in the right to sell the stock at 45. Let's say ZOE is the next Apple, and ZOE trades up to $500 or $600 over this eight-week period. Probably not going to be a whole lot of value left in that September 45 put. We would need to stretch this payoff diagram out like that. So at May expiration, if ZOE is below 37.5 near May expiration, the put's in the money, and I put near May expiration because we will, if that option's in the money, we will want to buy that option contract back. We don't want to go through the assignment process where we end up with a long position in ZOE. Now, if ZOE is above 37.5 at expiration, we actually would just let that option expire. We've got a open position. Both these option contracts don't expire at the same day. We'll have an open position in that September 45 put, And in this case, we're going to need to, in both cases actually, we're going to need to make a decision on our September put. And there are three trading choices here, actually. We could sell the ZOE September 45 put if if this trade was just based on benefiting from that time decay difference. We can continue to hold it, or, and there's a reason this one's in a different color, we could actually sell another closer dated ZOE put, benefit from a little bit more time decay. And that's what we're going to do. We were looking at May expiration. Now we've got 30 days until June expiration. I'm going to say that our stock hasn't moved at all. ZOE is trading at 40. So we benefited. We had that 37.5 put expire with no value. We've got the 45 put, the one that's still open, trading around 640. We've had some time decay there, but not as much as we got out of our short option. We still think, we believe that stock's going down to 37.5, and we were just early. We think that stock's going down to 37.5 over the next four weeks. And this being May expiration, we look out 4 weeks, and we're looking at June expiration. So a few moving parts in here. We're going to sell another one of those 37.5 puts. We only have 4 weeks to go here, so we're only going to get 60 cents for that option contract. But we've got a running situation here where we've sold $1.60 worth of options against an option contract that costs $6.90. Our net running cost on this position is $5.30. We're going to look at this in I promise to keep the math somewhat simple. I know it's getting a little convoluted, so let's look at a table and I'll circle back to it once again. Now, we started out with that September 45 put trading at $6.90. We had sold one of the May 37.5 puts and taken in $1. Now we're doing our second selling trade and leaving that long option contract open. We're selling a June 37.5 put 4 weeks out. We're taking in 60 cents. Our net cost, our net running cost on the trade now is again $5.30. We're short that June 37.5 put, as with the other examples. The value that's going to be in this option contract, if we overshoot our target, it's going to be working against us. It'll be $2.50 if we're down at 35. The passage of time is going to have a little bit of an impact on the September 45 put again. We've got some different prices here. We're down to $7.95 from our previous table where we had $8.25 if the stock's at 37.5. Our net running profit here, we did have $2.30 or so. Now we've got $2.65. You can see even if we overshoot, we've got a decent profit on our trade. We're going to look at a payoff diagram. This payoff diagram is going to combine all three of those trades, kind of our running trade. You can see there's a little bit more room here with our stock at 40. If the stock hasn't moved at all, we've got a little bit more of a profit from this trade. Our maximum profit now, with having done 2 sells and 1 buy, is $2.65. Our break-even has improved a little bit. Remember, our break-even before was $40.75. And our maximum potential loss is now down to $5.30. We did have a maximum potential loss before we'd sold that second option of $5.90. And once again, at expiration, if ZOE is below 37.5, we want to make sure we remember to buy that option contract back. Our motivation here was to benefit from time decay, not necessarily end up with a position in ZOE. We've got another decision to make. We've got a decision needs to be made about the September put, and we've got those 3 choices once again. We can either sell the put, hold the put, or sell another closer dated ZOE put. And in this case, what we're going to do, we're going to take a look at just holding on. We think we're long-term bullish, and we're not comfortable selling another put option. We think the bottom's getting ready to fall out of ZOE for one reason or another. So we want to have bearish exposure, and our bearish exposure here is going to be through continuing to hold that September 45 put. It's got about 90 days left to expiration at this point. At June expiration, the ZOE is trading at 37.5. We're long one of the ZOE 47, one of the 45 put, excuse me, one of the 45 puts, and now it's at 795. We're ready for that move lower, so we're going to continue to hold on to that September 45 put. No trade. Right now, we basically own, one way to think about this is we own that September 45 put, and the net cost for that put is $5.30. We've offset some of that cost. And we're going to go to September expiration. We're going to see what the value is at different prices for our September 45 put. Our original cost there was $6.90. The value for our September 45 put, but our target price for a little while was 37.5. Now we feel like it's getting ready to overshoot and make its move to the downside. We also have that profit from those two option sales. Remember, we took in $1 on the May option contract, and then we took in 60 cents on the June option contract. Then we decided to hold our put for 90 days and let the stock start to move lower. And there is our profit and loss. Let's say we felt like we were going down to the low 30s. Well, we've got a little bit better profit. We've enhanced our profit somewhat from selling those option contracts and benefiting from time decay just a little bit. And another way I like to show these things in different ways, one way to take a look at this is we're combining at September expiration, having $1.60 of profit from selling a couple of puts, and the value of what's open at September expiration, that 45 strike put. Maximum profit. If our bearish outlook is as bearish as it gets, and ZOE trades down to zero, we would have $39.70 of profit. We have a bearish outlook on ZOE, but let's not wish bankruptcy on the good people at ZOE. Our break even is $39.70. Well, remember our stock was trading at 40 when we first initiated this trade. So if stock doesn't move at all, we actually would have a loss of about only 30 cents or so. And then after the two options that we've sold, our maximum potential loss at the stocks at 45 or higher at expiration is $5.30. And just take a comparison look here. There's our diagonal strategy where we are selling a couple of options to benefit from the passage of time. And if we had just decided to buy one of the September 45 puts when we first took a look at getting short exposure to ZOE, that's what the payoff would look like. You can see the payoff differential at September expiration. Our break even has improved by $1.60 by selling a couple of option contracts. And our maximum loss is a little bit superior. We're being a little bit more dynamic here, but I feel like when individuals again are trading option contracts and trying to take advantage of an outlook for the underlying stock, trying to find a way that you can have time decay or the passage of time work to your benefit is I strongly encourage that when individuals are taking a look at trading option contracts. So in summary, on the two bearish outlook, R. Wang is asking, what is the maximum profit for that diagonal strategy? Right there, $39.70. If the stock goes all the way to zero, and we have a negative outlook on ZOE. I don't know if we want them to completely go out of business there. So. Bear spreads, pretty basic, straightforward, good first spread trade for individuals to take a look at. Diagonal spreads, a little bit more dynamic. You can do a diagonal spread with just one transaction, or you can do it as part of a longer-term program where you're trading around an outlook on a stock. I like opportunistically selling option contracts when you when you get a move in your direction and you think maybe it's a little bit overdone. The nice thing about both of these spreads is you do have some sort of short option, and you are benefiting from the passage of time or from time decay in one way or another. So there is my contact information and my website. I'm at the CBOE, cboe.com/learncenter. We've got we have more on diagonal spreads. We've got more on calendar spreads if Constance wants to take a look at the calendar spread. And we offer a wide variety of classes throughout the year and tours of the exchange, which usually kick in around summertime, so we might start scheduling those fairly soon. And you can find out about those at that second link right there. And with that, I believe that is my last slide. I think I see Cynthia moving around just a little bit, although she is several states away.
Oh boy, you've got your eye on me, Russell.
Yeah, people are like, how in the world? I can't really see that.
Well, you knew I was going to be jumping in here because I do have a request to ask all of the attendees. Notice IB's management does ask me to run a poll in each of my events. Now, please hang on. I'm going to put that poll up on the screen, but I also want to invite any questions that you have at this point for Russell. If you take just a couple of moments to answer those multiple choice questions on our poll, and don't forget to hit that submit button down at the bottom. That actually allows me to compile those results. This I do run through with management on a weekly basis, so I do appreciate your help. Now, once you have clicked that submit button, you can also use the X on the polling title bar to simply close that window down and get back to the chat panel. Now, if the chat panel has collapsed, double-clicking that title bar will actually expand it. Poll's about to end, so please click submit. Whoops, there we go. Okay. So thank you, everyone. Now, just remember to remove that polling panel, get back to the chat panel for Russell. Simply use the X on that panel title bar. Okay, looks like we've got some questions coming in. Russell, have you had a chance to read those questions?
Let me see. I was just looking. I was reading the poll.
Reading the poll. We do this all the time.
Let's see. We had a couple of questions about getting slides. How do we go about doing that? Can people email me, or how do you want to?
Actually, Russell, they will appear in a pop-up window as they exit today's event. We have it set up like that. It is a PDF copy. You can either choose to save it to your machine or simply print the slides out from there. They'll also be included on our archive page on the Interactive Broker website. There's an education menu with a link to webinars, and if you simply drill down through there to our industry-sponsored events, you'll find for the CBOE, all of Russell's, by the way, are included on our website. There is a filtering box up at the top where you can locate either by co-sponsor, the CBOE, or by presenter, and simply using those boxes will help you filter through all of the available recordings that we do have there.